Within the last 6 months, the CEOs of Nestle, Boeing, Starbucks, Peloton, Paramount, Zillow, Amazon Web Services, Snowflake, Hertz, HSBC, Grayscale, Under Armour, Papa John's, and Discover have all stepped down, voluntary or otherwise, from the top job. Collectively, these CEOs controlled companies with trillions of dollars in annual revenue, and now they are all gone. These were just the big names too. CEO turnover in companies of all sizes is now higher than it has been since the start of the pandemic, which begs the question, why is this happening? And why is it happening now?
The CEO's going after 2 years, another headcount reduction.
YouTube chief Susan Wojcicki, she is stepping down. She announced so in a blog post. And
Starbucks' CEO Lakshman Narasimhan is now stepping down as CEO and director. That is effective immediately. The company has named Chipotle's CEO.
Chief executives and other C-suite executives are just employees like any other, which means eventually they either quit, get fired, or die in their jobs. CEO layoffs have spiked, but maybe that's not too surprising considering layoffs in a lot of industries have also spiked. But this is actually not normally how it goes. If you ever find yourself in the top job at a major company, you should know that your position is simultaneously far more secure and far more fickle than the average rank-and-file employee working under you. As a CEO, your position is unique because there is no other employee at the company with the authority to fire you. The only people that can do that are the board of directors, who themselves are representatives of the shareholders. During periods of uncertainty, the last thing that companies want to do is switch up senior leadership unexpectedly, because that signals to the market that something is not right, which could tank the stock price. Since the board of directors represent shareholders and individual directors usually are major shareholders themselves, they have an incentive to avoid doing anything that could hurt the stock price unnecessarily. For this reason, CEOs are rarely fired outright and are instead offered generous exit packages to step down amicably in a way that won't scare investors in the business. Outside of high-profile cases where the business has clearly been mismanaged or in cases where the CEO has made very unpopular decisions, it can be hard to tell if outgoing CEOs have been pushed out or are simply retiring. According to Fortune magazine itself, the average age of a Fortune 500 CEO is 57 years old, and the average compensation package was $16.3 million. If you are that old and have that much money, it's not unthinkable that you would want to retire or pursue less intense roles more suited to your old age, like political office. But if CEO exits are treated so seriously and secretively, why has there been such a big spike all of a sudden? Well, the first reason is that right now is a convenient time for a shakeup. Companies and their leadership don't always have completely aligned incentives. A CEO wants to make as much money as possible while in the role, and the business wants to maximize returns to its shareholders. While these incentives can be aligned through bonus packages tied to stock performance, this has made a lot of company leaders hyperfixated on quarterly financials and the stock price on the day their bonus is calculated. Stocks in most large public companies have actually been trading relatively flat. Total stock market performance has been massively bolstered by Microsoft, Google's parent company Alphabet, Nvidia, and Apple, to a lesser extent. Most other public companies have been trading relatively flat, which isn't a problem during uncertain times like the pandemic and its recovery. But investors are now starting to expect more out of their businesses, and specifically their CEOs during a drawn-out period of slow growth. Former CEO of Starbucks, Lakshman Narasimhan, was pushed out after spending just over a year in the top job. While he officially stepped down, it was clear that the company performance was bad, and he was forced out by the board after sluggish earnings reports were released. He was replaced by Brian Niccol, the CEO of Chipotle, a brand which, by comparison, has been doing extremely well. This one move replaced the CEOs of two companies, and the decision was largely pushed through by activist investors like Elliott Management, who, according to CNBC, purchased a large stake in the company in mid-July. This firm and others like it buy up large stakes in companies that are not doing too well and try to enact changes to turn the company around. This can be as simple as suggestions like offering new products, but it's usually more focused on cutting unnecessary expenses and shaking up leadership to generate the highest possible return in the shortest possible time. This particular type of investing strategy is extremely attractive in stagnant markets where it's harder to generate strong returns by just buying something and passively waiting for it to be worth more. This has already worked for Elliott Management. After the announcement of the new CEO, the company stock jumped by a massive 24%, fully recovering its losses from its poor earnings report. If the investment firm cashed out on their position now, they would have already outperformed expected annual returns in a little over a month. Starbucks is a high-profile example. But activist investors across the country and the rest of the world are looking for similar opportunities. So many CEOs in stagnant companies are taking it upon themselves to bow out before they are forced out. Now, if you are not a CEO, you might not be too worried about the games that the company directors play with finance bros and their appointed CEOs. But it's time to learn how money works to find out why the great CEO purge is likely to impact you more than it is the people in the C-suite. This week's video is sponsored by Brilliant. I've been wanting to improve my problem-solving skills, and Brilliant has been the perfect platform to help me achieve that. Brilliant is where you learn by doing, with thousands of interactive lessons in math, data analysis, programming, and AI. Brilliant is designed to be uniquely effective. Their first principles approach helps you build understandings from the ground up. Each lesson is filled with hands-on problem solving that lets you play with concepts, a method proven to be 6 times more effective than watching video lectures. Plus, all content on Brilliant is crafted by an award-winning team of teachers, researchers, and professionals from MIT, Caltech, Duke, Microsoft, Google, and more. With Brilliant, you're not just memorizing facts, you're developing critical thinking skills that make you a better thinker. It's a platform that helps you build real knowledge through problem solving. Recently, I've been exploring Brilliant's new data content, which uses real-world data to train you to see trends and make better informed decisions. From Bayes' theorem to multilinear regression, these courses are perfect for learners at any level. To try everything Brilliant has to offer for free for a full 30 days, visit brilliant.org/howmoneyworks or click the link in the description, and you'll also get 20% off your annual premium subscription. The CEOs that did well during a stable upmarket are not the same kind of CEOs that businesses are going to want when sales are flat. If businesses can't grow revenue, the only option they have left to increase their profit is to cut their expenses. Of course, they could be happy with consistent, predictable returns. But let's be real, that just makes them an even bigger target for activist investors looking for their next company to turn around. Now, this isn't always bad. Established companies often do pick up a lot of dead weight over the years, from underperforming product lines to bloated middle management. It's normally much easier to add something to the business than it is to take it away. Activist investors may be a nightmare for existing CEOs, but they can genuinely help to save businesses that are collapsing under their own weight by putting a subjective set of eyes on the business and its operations. The only problem, if a new CEO is hired with the objective to cut costs, they are going to cut costs no matter what. And that's the second reason behind the current CEO purge. Brian Niccol, the new CEO of Starbucks, made investors so excited that the stock jumped 23% upon his announcement. He is clearly a competent company leader. Before his services, Starbucks is paying him $130 million in his first year alone, according to Yahoo Finance and company filings. If the name of the game was to cut down on expenses wherever possible, that is an interesting place to start. The real reason that investors are so excited about this new CEO is that he also isn't meant to be in the top job for long. Niccol has a long history of being extremely heavy-handed with cost-cutting measures, which have admittedly included streamlining the operations of Chipotle in his last job. But it also meant coming down hard on employee benefits, cutting down on staffing, closing underperforming stores, and pushing back hard against unionization efforts from staff trying to collectively push back against these cuts. Starbucks is currently dealing with its own unionization efforts, and the part of this new CEO's job that the company won't talk about in their press release is to shut this shit down like he did at Chipotle. The company isn't expecting to pay him hundreds of millions of dollars for more than a few years. They are just hoping to pay him long enough to fix their problems before he moves on to another company that will pay him a huge signing bonus, and then Starbucks can replace him with a longer-term CEO that is only paid a modest salary measured in the mere tens of millions. These people are unofficially called turnaround CEOs because their job is to turn a company around and then get out as quickly as possible, and their bonus structures are normally written to pay them a lot of money for quick results. Of course, the company will never publicly admit this plan, so that prediction is based off my experience with other companies employing turnaround management. Although, if for some reason you are watching this video 5 years after it's posted and Niccol is still the top dog at Starbucks, feel free to leave a comment telling me how stupid I am. Anyway, these short-term CEOs inherently increase turnover rates as they jump between companies providing their services, and turnaround CEOs are more popular with investors in markets where it's harder to find value. Now, the final reason that CEOs are quitting in record numbers is the simplest reason, which is that they really don't need to work anymore. The average CEO is older now than they have ever been before, and a lot of them just want to retire. But during the pandemic, their companies tried to hold on to them to maintain corporate stability. According to the corporate law firm Challenger Gray, Q1 2024 had the highest number of CEO resignations since they started keeping records. The number one reason that CEOs gave for leaving was to retire given how much they were paid during the pandemic and the strong market returns of their investments over that period. The modern CEO is also expected to be more tech-savvy and public-facing, prompting many of the old guard to make an exit before their marketing team orders them to do a TikTok dance. Now, you might think I am joking, but this new wave of corporate culture has had a serious impact on the C-suite. CEOs may be missing out on some job security, but that's probably not their biggest problem. Companies are shaking up the pool of chief financial, marketing, operating, and executive officers with chief enthusiasm officers, chief amazement officers, and chief heart officers. These are real jobs held by real people in real companies. I am going to be writing about this trend over on my completely free email newsletter linked in the video description. If you want to read that and other articles like it, which will never be made into videos, be sure to sign up. If that still hasn't scared you out of going for the top job, go and watch this video to find out what it really takes to land the top job. And don't forget to like and subscribe to keep on learning how money works.